Treated myself to a steak last night because it was another good day in the market because the market keeps going up, Tom, which, as you know, I've just been a consistent cheerleader of for the past few months. And I think it will continue.
Okay, so I'm curious, is that your topic?
That is my topic, and let me explain, dare I say, why I think this market will continue to go up. About a month ago, when we were here on Let Me Explain, we pointed out that the market had just staged a rally in November, December, January, and February, and that was a pretty unique occurrence. In fact, when we look back through history, the forward 1 month return for the market in the month of March was positive. At the time, we noted that the market traded higher about 79% of the time to a gain of about 2.1%. As of today, the S&P 500 is up by 2.6%. In early March, we did a study about whether or not S&P 500 sentiment was done. We looked at the bull-bear spread in the AAII investor sentiment survey, and we came to the conclusion that no, it wasn't, because when you looked at the 1 week, 1 month, 3 month, 6 month averages thereafter through the entirety of the data set, the 71 occurrences told you that the returns were still positive. Now we're winding up another month where we have positive gains. So it's now November, December, January, February, March. That is also a very unique occurrence. It's happened a handful of times. It's happened so few times that you could actually say that it's still a positive thing. In the 11 occurrences in which it's occurred, the market's traded higher 82% of the time to an average gain of 1.8% in the month of April. For the rest of the second quarter, it's an average gain of 2.9%, 64% of the time. And for the rest of the calendar year, every single time, 100% of the time, the market's rallied for 11.9%. So what we've seen here the past few months is astounding. 17 of 21 weeks up for the S&P 500, a gain of 27%. That's never happened before in history, ever. This is a very unique market, but it's not a market that's showing any signs of statistical characteristic of being done yet. This is more characteristic of a market in the middle of a bull run rather than one that's closer to the end. So there's a lot of people out there trying to say the risk to reward at the highs is good for taking a small short. My compadre on overtime, rather my compadres in overtime, Ilya and Dylan, keep trying to do that, much to my chagrin. I can't convince them otherwise. But the outlay here, history tells us that this is really not the time and the place to try to short the trend. There still could be legs left to it if this is anything like what has happened before in these markets.
The first thing I'll say is that those are interesting statistics, but you know that, past performance, we don't have to get into the
never indicative
details of
course.
Past performance. And I think each one, there are characteristics that are definitely similar in all those bull cases, and there are characteristics that are different. In a lot of those bull cases, we may not have been as long in the tooth as we are now. I feel like this has been, and we also, that's part of it. And we also may not have been as concentrated as we've been in this move, like with just a handful of stocks essentially leading this market to these levels. So you've had long in the tooth and a handful of stocks. But again, the positive side to the argument is there's never been this much liquidity ever forced into the system, and there's never been this much cash on the sidelines in pretty much in history. On the negative side to your argument, Chris, I would say this is the fewest number of shorts I've ever seen. Like, I have never, usually when we get markets at this level, all I hear about is like, people walking on the ledge that are short, all this kind of stuff. We're getting none of that. Like, this is one of the most complacent, one of the most lackadaisical rallies I think I've ever seen. I've never seen this much confidence. I feel like, and I don't feel like this is a short squeeze. I also feel like there's situations, Reddit being one of them today, just with the stock, up another, it's essentially doubled, almost tripled from its IPO price, not tripled, but doubled, or 2.5 times. A couple other stocks, like I saw that Trump's new stock was up $20. I mean, like, there's just a lot of meme stuff going on. And it's not that these companies are grossly mispriced. It's just that there's this level of optimism. I think you have to just see what's
the dollars are just chasing anything that they hope will work.
Yeah,
that's what it is.
Yeah. No, it's
not,
a little
not
bit
disagreeing with anything that Chris is saying. That's not.
Yeah, I don't disagree.
But there is a lot of complacency here, and yeah, you can be a bull here, no problem.
But there's one other thing, TP. There's, we'll sit here and we'll say, and you'll say the same thing. You'll go back and you'll say, I mean, smart money always says to buy when things are cheap and to sell when things are expensive. And you're never going to know what the top is. And it's not a fair assumption to say, well, I'm going to wait till they turn, because that's also next to impossible. Every trader knows it's impossible to wait till they turn. So you have to be early. So the question is, are you playing with fire here, not lightening up and thinking that, you know, there's still some room left to the upside? And are you really, you know, is that really the smart move? And I'm going to argue that the whole argument that, you know, we've still got a lot of room left to go, unless you think that that lot of room left to go is more than, let's say, 5 or 10%, then it doesn't make any sense to me, just based on the fact that there's way too much risk on the other side.
It's hard to get rewarded from what I see in the options anyway, in the ES and the SPX options as a bull. Yes, the volatility is low, so you can't sell any puts. You can get into long debit spreads. That's my world, but it's hard. And again, Chris, I can understand why this market could go up another 500 points, but it's hard for me to see the rewards on the bullish side. If that's just me.
Yeah, I mean, it depends how you structure the trade. What's been working for me for the past few months really has been the long call spread. The long side of that is just below where we are. You know, it's in the money, and then the short call is deep out of the money, about 5%. So it kind of caps the gains that you have over a given month.
That's a smart way to do it. Smart way to do it.
And it's just as long as the trend, and you're a technically inclined guy, like the trend is still clearly up. Momentum is still pointed to the upside. You may see some divergence, but corrections can happen not just in price, but through time. And the NASDAQ, you could argue, has corrected through time over the past month. It's shaken off some of those excesses. It may be gearing up in a flag for another move higher, and a long call spread can benefit from that. Volatility is low, so selling the puts really doesn't work there. The Russell's a different story. There is a little bit more vol there. But I want to take this a step further, because you guys are bringing something up, which is to say that this is reminiscent of, say, January 2021. When GME and AMC were all going nuts because of all the apes on Reddit. And now Reddit perhaps is a meme stock. You're seeing some wackiness in the Trump name, although I think there is a reasonable basis for that. If he doesn't need to draw liquidity together to pull together $454 million for a bond, it's only 175. Maybe that means he doesn't need to sell as much stock. So that's going to be less downside pressure. I can at least like tell myself a story there to make that make sense. Mm-hmm. But the excesses of January 2021 didn't mark the top of the market there. Those continued for the rest of the year. We had the big run up in tech stocks. You had the big run up in ARK, for example, through November of that year. The S&P doesn't top out until January 2022. And this is reminiscent of an environment where the Fed was making a policy mistake back then. I didn't get to react to the Fed in real time last week, having been on the mend, but I did listen to Powell's press conference afterwards. And it's pretty clear that Powell and Co are saying that we think that the road to 2% is going to be bumpy, and we're confident we're going to get there no matter the bumps we encounter along the way. So we can still talk about cutting rates. That's perhaps an environment where asset prices are inflated, at least in a very short-term window. That's kind of like 2021, when the market was telling us, hey, inflation is going up, inflation expectations are going up, and the Fed was saying, we're not going to raise rates, we're not going to raise rates, we're still going to keep rates low. That was an environment where stock prices were able to succeed still. You get a rally that goes on for another 9-10 months after the GME, AMC nonsense, even while bond yields are starting to move back up. And if that's where we are right now, because the Fed is playing with fire, that doesn't mean that this bull market is done yet. It means that the crash and the pullback later on could be more violent. And Tom, when you think about the concentration in this market, when stocks eventually do pull back, it's probably going to be an aggressive move because everyone is in the same trade.
Yeah, but I
but the conditions aren't there right now for that to happen in the short term. We could still see this bubble go and go and go because the Fed may now be mismanaging things. And that's inflationary in the short term, at least for stock prices.
I understand everything you're saying. My argument with it again is that you, me, TP, anybody else, you will not have this market reacts too fast. It does not give you a chance. Like, you either have to sell into strength as a part of your trading culture, your methodology, or you don't. Like you cannot be an active participant in the markets and not sell into strength. You can be an active trader, buy when things are cheap, sell when things are expensive, and always do that kind of stuff. But if you don't sell into strength, then you're just a passive investor. And, you know, That's my argument. Like you are giving me the speech for why a passive investor would be fully invested. And again, you would not have participated.
They've been fully invested for the past 10 years.
Yeah, I was going to say you would not have participated in the last 15 years if you weren't passive and all in the whole thing. And this has been an unbelievable bull run and all that kind of stuff. And yes, and all that's true. But if you're an active trader, you have to buy into weakness and you have to sell into strength. There is no other way to survive. There's no such thing as closing your eyes and letting something run its course. That's not what active traders do. Active traders sell into strength and they buy into weakness and they sell when volatility is high and they cover when it's lower. Like everything is essentially some form of mechanics. There's also, yes, there are also active and trend and swing traders, but again, it's a very short-term perspective. That's the difference. You're giving me like a very passive, long-term perspective. That's
actually, I actually disagree. I think the roadmap is because of this statistical backdrop here of stocks continuing to go up. It should give traders who have been riding the trend and buying dips in stocks when presented opportunities in recent months. If volatility spikes and stocks come down, how do you approach the situation? Stick to the playbook. That's really the thing here. Part of being a mechanical trader is having the discipline to stay within a system and not getting spooked out of a trade just because it's worked 4, 5, 6 times in a row. You can go back to
the other side. That's your argument, which is fair. That is your fair.
That's my argument here, right? If you look at the look back tool on tastylive.com and you say, if I were to do the 45 days in, 21 days out, either doing the long debit spread or short put spread in ES or incur starting November 1st, right? Not the exact low, but arbitrarily November 1st, you're 4 or 5 trades in now. You have a 100% hit rate on every one of those trades. Mm-hmm. And the environment statistically suggests that we're still in that kind of environment. So stick to the plan, what's been working. There's no reason to get fancy here. If you've been doing something that continues to put shekels in your pocket, don't overthink this market because it's up 27% in such a short period of time. That may mean nothing. This is a record run. We don't know when it's going to stop, and there's no reason trying to be too clever to try to call the top, in my opinion, because the evidence there isn't like, hey, sentiment's too extreme. Hey, positioning's too extreme. Hey, historically, when we go this far, this fast, it means that the market has a negative skew over the next few months. No, none of those concerns pop up right now. This is typical middle of bull run type of behavior. And so don't be afraid of the bull. Embrace it while we have it. It's the best run in history. Embrace it while we have it. This does not come around often. So if it's working for you, stick to what's working. Buy dips, stay long. That's my MO.
Okay. Okay. I understand where you're coming from. It's different. My perspective on it's different. If you're a trader, then if you don't want to get short, fine, don't get short. But you lighten up longs into this. Like there's not, sure. It's not a kind of market where you say, oh, you know what? I think there's more room to run. Obviously there's lots of stocks out there.
And for a trader, there's 100 other things to trade.
Plus there's a lot of stocks that are on their butt.
So I can believe and accept everything that Chris is saying. He's right. Yeah. Absolutely. And I still don't want to buy the top of what I'm a little nervous here. I don't want to buy into strength. So maybe I don't trade the S&Ps. Maybe I look at anything else. But yeah,
I just think I've been around a long time trying to catch something, trying to sell into something as it's going down, and trying to, sell into the hole is way harder than selling into a rally, which is actually very natural. All right, TP, anything else you got?
Not for Chris.
Chris, anything else you got? You want any other topics you want to talk about? You got a couple seconds here.
It's very interesting. No, that was a great description of what's going on.
I know that oil prices have gone vertical recently, and Tom, I know we call it a one-trick pony around here, but the selling of puts for the past few months has been working out well for a lot of people. I would just question the fact that we don't see much volatility here right now, and so while we're coming into the September highs, in what's been a pretty much of an orderly market right now.
You're talking about oil. You're talking about oil.
Yeah, in CL. I don't know if this is the place where you necessarily want to be looking to sell call spreads, even though we're getting to range resistance, multi-month resistance. The volatility profile doesn't necessarily skew towards that kind of outcome right now in the short term. So just be patient there. Continue to roll it up, but momentum's positive. Otherwise, we'll be back next week because the April seasonality, Tom, April's one of the best months of the year for stocks. So we'll see what happens.